Hi everyone, this is Terry with Futures.io, and it's my pleasure to welcome back Peter Davies of Jigsaw Trading for today's webinar, Volume Spikes, Understanding and Exploiting Them. Now, during the webinar, please feel free to type your questions into the questions box, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to the channel. It really helps us a lot. For futures trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to Pete, and you will get the pop-up to share your screen.
Okay, hi all. Just give me a second. Thank you, Terry, for that. Let me just put the screen share on. Okay, so I've got the screen share on. So if you just give me a Y, if you can see that.
Yep, looking good.
Okay, so today we're going to talk about what appears to be a scary trade, which is fading volume spikes. In other words, trading against fast one-way moves in the market. Before we get into that, we'll just pull up the disclaimer. You've all seen this before. One of the things to bear in mind that's not in the disclaimer is when you listen to any trader, they're talking about trading from their own perspective of risk, and we've all got different risk profiles. That definitely applies very much to these volume spikes, as you'll see later. Okay, so let's move on. So we're going to talk about what to look for with the volume spikes, how to enter, or how I enter, and how to know if the trade is working or not. In fact, we'll actually discuss the various outcomes of this trade, because this trade isn't just a win or lose trade. It's like a progression or a cascade of events in the market that occur one after the other. And we'll talk about how to identify each one of those events in turn. So to keep this simple, I'm going to talk about moves down that turn up most of the time, right? So consider moves up that turn down to just move in the same way. And that saves you from stepping on my tongue too much by saying, and the reverse for shorts, right? So we're going to look at why this works, how to recognize it, and how to actually manage your trades. And then finally, we'll look at how to make it work for you, because nobody can actually push the button for you when you sit in there trading. Now, you've probably all been to a lot of these webinars, you know, where you've got high hopes at the start, but a little bit of disappointment afterwards. And sometimes that disappointment is because, you know, the whole webinar was a sales pitch with nothing of value. Sometimes you're disappointed because you didn't actually know what was the next step you should take. And sometimes you're disappointed because you were looking for an easy way to make a lot of money. So today we'll actually see the setup explained in its entirety. The steps to get this to profit are going to require some effort on your part. But the great thing about this effort part is it's also going to put yourself on the path to independence as a trader. Now, obviously, many of you are looking for financial independence as traders. But one of the things that I've seen with most successful professional traders and just traders in general is that most of them are able to find their own trading setups and develop those as the market changes over time. So the setup I'm going to show you today and the way that I approach it, as far as I know, it's unique to me, or rather I didn't actually learn it anywhere. The market taught me this setup. Now, for a lot of people, it might seem like an impossible goal, especially to those of you who've put a lot of time into trading but didn't get anywhere. But I want you to just open your mind a little bit and set your sights a little bit higher than you might already have them set. So let's kind of forget about the target of getting to profit, because that is really just a milestone on your journey as a trader. Your goal really should be able to move past that and develop skills that will enable you to change with the market and define your own profitable setup. So with that in mind, before we start, I would like you to consider that what we're going to discuss today is really a market behavior, and on top of that, one way to kind of approach or attack that behavior. Now, I'm not saying that this way of approaching it is the best way. It's just what I developed myself. So you could absolutely find a better way to do this than me. But what is important is that you understand the behavior before you start throwing money at this or even sim trading it. So if you're not yet profitable and trying to make sense of trading, this is actually a really good place to start because it doesn't need any indicators and it doesn't actually need any long-term analysis. It just takes some time to develop your skills trading this series of events. Something you'd be able to spend, you could spend the next few days validating that what I'm saying today is true, and after that it's up to you if you want to pursue it. And you don't have to take anything on faith today, right? Because you will be able to see these playing out in the markets yourself. If you look at crude, if you look at gold, just tomorrow and the next couple of days, you're going to see this playing out. Okay, so how did I get into this trade myself? Well, as many as you know, I do really like trading the S&P 500 futures. It's what I kind of grew up on as a trader. And I've been watching it every day for more than a decade, or most trading days rather. I don't watch it every trading day. I'd say I watch probably 95% of all trading days in the S&P 500. Now, the second half of 2017 was pretty frustrating for me. It's been a really slow market, and it's gotten past the point where I was willing to spend too much more time at the trading desk watching the S&P do nothing. So I started looking for some other, what I'd call fairly low maintenance opportunities to help me when the S&P 500 is dull. And that's what you're going to see today. So if you're trading the S&P 500, interest rates, or any other market that has kind of bored you throughout 2017 and is looking, at the start of this year to still be a little bit low on volatility, this is actually a really good second trade you can look at. If you're struggling as a trader, just understand that this isn't something you can apply tomorrow, but it is something you could start to apply in a few weeks' time. So like I said, there's some work to do between seeing this webinar and starting to trade it. And I'm going to tell you what that work is, but basically it's all about building some firm expectations as to how this will play out in your target market. I'm not talking about rocket science, just talking about a little bit of discipline. Now, before we look at this trade, let's just talk about what this trade isn't. Okay, so this is not a trade that occurs in any predefined location. In other words, doing any sort of prep before the market opens is not going to help you with this trading any meaningful way. And that's worth noting because, for me personally, I see a lot of trading plans, and I've seen a lot of trading plans lately that start off with some kind of, here's my yearly analysis, my monthly analysis, my weekly, my daily, and then you go down and down and down and down to the trade plan, and it's got target 2 ticks. And if you're scalping for a couple of ticks, you really should be able to do that without the market reaching some predetermined area you want to do business. You shouldn't need a weekly chart for a 2-tick scalp. So there is a belief that every trade you take must be taken based on a top-down approach to start from kind of the outside, the longer term, and work your way down towards shorter term analysis to look at, you've heard of these kind of multi-time frame analysis. I'm going to look at the 60, the 30, the 15, the 5 minute, the 1 minute, all that kind of thing. There's some belief that you have to look at the higher time frames and then the lower time frames. Now, I'm not saying that's a bad thing because you've all seen my prep, or most likely a lot of you have seen my prep on Futures IO, and for the S&P 500, I do indeed do long-term analysis before actually getting to my trading day. So I'm not saying it's a bad thing to do analysis before your day starts, to have some preconceived ideas of where the market might react, but it's not going to help you with this trade. And it's not going to help you with quite a lot of other trades. So, don't worry about overall direction of the market for this. And don't think you're doing something wrong by not having that longer term analysis. And there's a lot of trades like this, right? It doesn't make these trades worse or better. It doesn't make them more or less reliable. It's just different, right? It's just a feature of this kind of trading that it's going to happen out of the blue. It's not really going to happen, in a predefined location. So if you've got in your head that pre-market prep or homework is mandatory before taking any trade, just keep an open mind about this as we progress and look at the different rules. Now, saying that, you're still going to have some homework before you can make this trade work for you. So this trade works in a lot of markets. It works in crude, DAX, natural gas, gold, basically the more volatile markets. I work in a lot of other markets too. I haven't looked in wheat, I haven't looked in corn, I haven't looked in the meats, I haven't looked really in a lot of the other metals. But in each of those markets that I've talked about, it does work slightly differently. So really the homework is more a kind of a longer term research of how it differs on your chosen market. So we'll look at crude and gold mostly today. There's an argument for saying you'd be better off looking at a market that I don't show you today, right? Because everybody else is looking at that one. But the key factors or the differentiators between the different markets are going to be how frequently this occurs, in terms of time of day, number of times per day, number of times per hour, how often you get false signals, and of course what the tells are for a false signal, the amount you need to risk on that specific market, what your typical reward will be, the key triggers for the trade, and what market state they work best in. So you might find on certain markets, these reversals work best in a lively market, a trending market, where the trend ends. And you might find in other markets, a break from a choppy zone is actually the better setup, okay? So these factors are actually going to be quite similar across the thinner markets that we're looking at, but you are looking for nuance. You are looking to say, well, okay, I might need to risk, 6, 7 ticks on crude. I might need to risk 10 ticks on gold, right? You can, for instance, expect a higher frequency of trades on DAX than you will on crude, okay? So if you've only got a couple of hours a day, the DAX might be a better place to look at this setup. On crude, you're going to see it more often between 9 a.m. and 11 a.m. Eastern time. So, if that's when you trade crude's looking good again. So before you take a single trade, you're going to need to observe, just take some notes so that you understand the behavior on your markets. And what that's going to do, it's going to remove many preconceived ideas you have of how you should approach this. And you might even find on some markets, you might end up trading the failure of this setup, right? Now, I've worked with a lot of traders that have gone through this observation process, and it's actually ended up changing a lot of their preconceived ideas, that they have about how to trade specific behaviors. But the majority of people just want to be told, show me where to get in and where to get out. And if that's you and you've been at this for a year or 2 or 5 or 10, just consider the merits of a couple of weeks studying a specific behavior. And I'm not talking like a couple of weeks full time. I'm talking about just let this play out for a few weeks and just watch what happens, right? Get to know it first, then start trading it, not the other way around. So the behavior that we're going to look at is actually quite simple. And this is the why of this trade, because the why it happens has to come before the how do we trade it. So at the risk of stating the blindingly obvious, a market moves down, generally speaking, because lots of people are selling at market. So on most days, the majority of the trading we see is actually short-term speculation. So we don't know the exact mix on any one day of short-term to long-term trades, but let's agree that there's always a bit of both in the market. There's always some short-term and some long-term players in the market, but the long-term players aren't going to react to short-term price moves. So on a short-term trade, on a short-term basis, as a day trader, we know that future short-term moves will occur when the shorter-term players react. So if it's only short-term players reacting to short-term moves, we can pretty much forget about the long-term players to some extent. Because what we're considering here, we're considering how the market might react in the short term, and it's the short term guys that are going to be reacting. So we can kind of say, well, the long term guys, I'm going to cancel those guys out. Now, the exception to that is obviously, when we've had a big news day, and we've got a one-way day with a lot of long-term repositioning, or we've just had the oil inventories, or we've got something big going on with OPEC on crude. Yet then, of course, there's a lot of long-term repositioning and a lot of long-term trade, but most of the time it's mostly short-term traders reacting in the short term. So as a market moves down, we've got here from left to right, market moving down, the number of short positions is going to increase as we move down. At the same time, the number of people willing to sell more contracts decreases, because basically people have had their fill. They've built the position size they're comfortable with. They can't sell any more contracts, right? And there's also, to an extent, people going, that's moved down a lot. and just not wanting to sell for that reason. So in other words, you've got more and more people that who's really their only future action is to buy in order to take a profit. Okay, all pretty obvious so far. But there is a little bit more, because we're all speculators here. And as speculators, there's probably nobody in this room that cares if a market is going up or down, right? You just want to be on the right side of the market. You don't really care as futures traders if it's going up or down, right? There's no restrictions on shorting as future traders. So when you think about other people in the market, you kind of people whose activity you're trying to predict, is it logical to assume that they're the same as us, that they really don't care long or short, that they're just here to exploit the moves? Well, personally, I think that's okay to make that assumption. So let's make that assumption. So what we want is for the market to get into a position where there's not that many other people that want to sell, and that will see them at some point putting in buy orders to unwind their positions, and that's going to give you a pop to the upside, right? But what will cause the market to really move is when the majority of speculators believe that the path of least resistance, or where the profits are, is now to the upside. And that's where, you know, looking for a continuation comes from. So ideally, what we're looking for, we want the market to pop to the upside after we enter, and then to see signs that speculators overall are jumping on board because path of least resistance is now to the upside. And if we don't see either of those things, then we've got no trade. Now, so far, I could obviously have just been talking about reversals in general. But what is unique with the volume spikes is the reversal occurs after a sudden fast movement. So we can see this big spike down here with lots of volume. We see lots of volume at the bottom. It's as if the market got a bit too excited and sold off a bit too hard. And we end up with a lot of traders potentially caught on the wrong side of the market. So let's look how this appears on a real market and walk through what's actually going on. So here's a couple of volume spikes that contain the elements that we're going to be looking at. Now, for those who don't know the Jigsaw tools, you could be looking at a footprint chart here, but I'm going to show you on the Jigsaw tools because that's what I use. So the circles show areas where a lot of volume traded. Okay, these circles here, and the red and blue just indicates the balance of trade. So blue for buying, red for selling. And down here we have the volume bars, and you can see here we've got a lot of volume at this particular bars. And again, with the volume bars, it's red for the quantity of selling and blue for the quantity of buying. Now, these bars here, the price bars, they're red and green again, just to indicate balance of trade. So red means more sellers in that bar, and green more buyers. So what do we have? First, we have a push down, and we can see we've got this push down. We've got excessive volume here, and we can see it's an extended move. And on the way down, we can see a few areas with circles, which just means here, here, and here, we had excessive volume trading. Now, what we're looking for at some point is some of this volume to get run over, for the market to kind of move back up through their positions, and for us to see a small pop as those traders get stopped out. After that, then we want to see some form of continuation. So in this first reversal, if we look down, you know, we can see down here, this is the first time traders got really run over. So we've got a lot of trade here, but we moved down. We've got a lot of trade here, moved down. Got a lot of trade here, and we did see eventually we saw a little pop to the upside, but it was a while before we got the continuation, right? So the market moved sideways for quite a while. The next spike up does something very similar. We pushed up. We see a lot of volume on the push up. We see a fairly small area with excessive volume. And then the market went sideways for 8 minutes, in which time we got more positions building in that area. And eventually we pushed down, the stops fire, and then the market started to see a more orderly march downwards. Now, no, we don't need this excessive volume to appear at the very top or the extreme of a move. So these are kind of thin, slippery markets, and we're just using this volume here as like a line in the sand. Yeah. Once the market moves through an area of high volume for the first time aggressively, it should stay on that side. We want to see it stay the other side of this high volume. So what we're looking for is fairly simple. We're looking for an excessive move with a lot of volume, okay? So the volume here, overall volume. And then we're looking for a cluster of trades or positions at a specific set of prices. And we're looking for them to get stopped out, okay? Now that's the easy bit. The skill to develop is in identifying when the market is really set to stop these traders out and get out of the way quickly when you're wrong, whether price moved against you or not. Now here is a fairly tame volume spike in gold. So what we've got a period of moving sideways. Now, what I will mention, what the market did before is going to affect this, right? So the fact that the market has moved sideways and then is breaking out of that sideways move is a different trade from a market trending down and putting in a final volume spike, okay? So just bear in mind whether we're breaking a range or not. So the market has pushed down. We can see a much larger amount of trade than anything we've seen earlier. And then we also have one price where we've traded an excessively large amount of contracts. Now, this doesn't have to be just one price. It could be several prices. But what's important is if we have an area, a concentrated area of high volume, an area with a lot of positions in it. So there was obviously some excitement on the way down, and very likely people got positioned because they thought they were missing out. And as the market starts to push up, they're going to be getting a little bit nervous. And we can see the volume traded at each price here on the way down. We can see it was much higher on the sell side. And on the way up so far, it's a little bit mixed, right? We don't really have, as we start to move up here, we don't really have a lot of volume on the buy side, but it is moving up a little bit. Now, if we consider the larger traders on the tape, it's also pretty mixed, right? So at this point, yes, we've spiked down. Yes, we've got an area of high volume. Yes, we are moving back up to that area of high volume, but it's pretty mixed, right? You could get in at this point, right? But there's no real major aggression from the buyers, right? They're not really hitting the market hard. Now, anyway, if I wanted to get in here, what I could do, I could enter if I wanted to at the circle or below. But personally, I want to see some aggression first. So for me, I don't care if I enter below the circle, at the circle, above the circle, right? It doesn't really bother me. That's just kind of your line in the sand. What I care about more than anything else is seeing some aggression, some confirmation that they are going to try and run these people over, rather than having to get a trade at a very specific price, okay? Because this is gold and it tends to run, right? So I'm not going to say I've missed my trade on gold because it's moved 4 ticks away from the circle, right? Now, what we can see now, we've moved on a little bit, and what we can see now, we've just started to have a flood of large buyers. Now, this screenshot, it doesn't really convey the kind of speed at which those guys came in. So it's boom, 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 boom. Right, these trades came in. What this tape's showing here, it's just filtered to show 10 lots and above. And so my take on this is that, they're moving up to here. We've moved up 3 ticks, 3 or 4 ticks there. They moved the market up 4 ticks. I think they're trying to run the market up. And this is where the skill comes in. Because if the buyers are hitting the offers hard like this, and they're getting some price progression, it's actually difficult for the market to fall backwards in the short term, right? So I'm going to try and get in with a limit order, as this is a fairly thin market. And I think a thin market, there should still be a bit of wiggle, enough to get me on a limit order. And as long as we see buyers like this participating, I don't really see this trade running against me. And that's just basic tape reading. And one of the skills that's going to help you with this setup. So just remember here, there's a bid here at 1282 because I didn't get filled, right? So, I tried to be clever. I tried to put a bid at 1282 because there's some wiggle in the market, but buyers just came in more aggressively, ended up getting in 3 ticks higher, which is fine. It's not great, but fine. Sometimes trying to be a smart ass and getting a good price, and you just get a worse price. That's okay. So what we saw a nice little push up here, right? as some of these late short speculators, these guys caught at the bottom, they got stopped out, okay? And then we've got a little pause. And this little pause is kind of like the second phase for these trades. So we're expecting this pop. We're expecting this first pop here because the traders in this area got stopped out, okay? Because it's pretty clear down here where the late sellers got stuck, right? I mean, you can see an area of high volume here. You can see there was a lot of activity here. So anyone sold in this area, they're stuck. And that's pretty clear. And I think we can say, well, as we moved up here, some of those guys got stopped out, right? But will speculators overall now feel that, okay, the upside is now more attractive, okay? So if we start to move sideways for a long period after the pop, it means the market's not sure, right? You have to excuse the noise here. There's a big thunderstorm outside. But if we continue to move up from here after the first pop, it means that short term, yes, the upside is now the path of least resistance. It means, you know, the market has likely fully reversed, and now we're going to see some decent upside. So the pop, the initial pop, is to stop out of the traders below, and the continuation is kind of the bulk of speculators feeling, okay, it's just easier to the upside now. So you enter, you see the pop, and then you look for the continuation. And this is where we got to. So when I first showed you that volume spike, this one here on the way down, I said it was actually a pretty tame volume spike for crude. And if you look for gold, sorry, and if you look back now, look at the volume back now, it does actually look pretty small on the volume chart. So on that first spike down, we'd actually broken, we'd had this range here, we'd broken out of a range and pushed down. In this case here, we have a market that has spiked after an extended move. So we've got the volume at the top, and we've got this big spike in volume here. So the volume at the top is just positions at price, which doesn't necessarily mean a lot more volume overall. It just means there's a lot more volume. There's a lot of volume at a price. And then down here we can see, yes, overall there is a lot more volume, if that makes sense. So this up here to me is often a much better trade. So it's quite common for traders, you know, to get caught up in the excitement of a move. So we've all watched the market move up and up and up and up, and with each push up, you're just starting to feel more and more like you're missing out until you can't bear it any longer, and you finally buy it, and then the market reverses and you bought the high of the day, okay? So we know if we start pushing down now, the late buyers up here are going to be feeling very nervous, as we all do when we buy at the top and it moves down. Then the earlier buyers that are still holding from the move up, they're going to start to feel like, you know what, it's time to take some profits. But make no mistake, selling at this point is actually quite scary because it's not what we're used to. And it's even more scary if you don't put in that bit of study time. Okay, so the market's just putting a big fast move up, and selling big fast moves up is not that comfortable. So we do need a little bit of confirmation. So if we look to the right over here, we can see some big sellers coming in, and we can see the market's pushing down a bit. Okay, and that selling continued. And now it's worth noting here that this white area above is just an area of high seller liquidity. In many cases, that could be a useful place for a stop. But in this case, I really wouldn't want to stop in this trade for a move that far against me, because once you start popping the high, that's when you're going to start to get slippage if it does move to the upside. Okay, but it's just kind of nice to see those offers above us. So on the tape here, we can see more sellers, and we can see the sellers are actually getting something for their money. So the larger buyers that we've got here are actually having the market move against them. So that's kind of perfect. But not every trade works out, and it'd be kind of dishonest of me to just show you the winning trade. So why do I actually have the stop order at this particular point, 84.6? You can see here just above that circle. Well, you can see that the buyers have kind of taken control. You can see this pop up here. You can see the numbers here and here. See the buyers are taking control, and we're close to the highs. Now, if we move through the high, we'll almost certainly see some stops trigger. So I want to get out before stops start firing to the upside. Okay, so like I say, if you put the stops above the old high, there's almost guaranteeing slippage, because that's the point where other people can have their stops as well. So if this was going to be a winning trade, then we'd have already seen a decent pop to the downside, right? Sellers would have already put their foot on the gas, and we'd have seen some buyers getting stopped out. As it is, we just didn't get that initial pop, that move when the stops got hit. So there's really no point staying in this trade. Now, the cool thing here is the risk-reward ratio. So we got into a trade when momentum, just a little bit of short-term momentum, downside momentum, was on our side. We're getting out because we've lost that momentum, and there's a risk if we move any higher, there's going to be a stop run against us. So the market so far has just moved against us 4 ticks. And that's really the beauty of trading these spikes. They're just not as risky as they first appear, as long as you try and get the order flow on your side and start to see some momentum your way, and then get out if that doesn't generate the pop that you expect when the stops fire, or just get out when the counter trend traders just stop trading. Okay, so let's just review the spike behavior. We're going to see some more examples in a second. So the stage that most of you are at with this right now is you've probably seen this happen many times, right? You're probably not seeing anything new. You know, maybe you've even been caught on the wrong side of a spike a number of times, you know, buying or selling the high or the low. Now, most likely, you've probably stayed away from trading spikes, thinking it's a dangerous time to trade. So we've got to tame the tiger, look at the spike rationally, and break down how the market behaves. So first, we have an aggressive, fast, extended move with lots of volume. Now, these are all relative terms, and they relate to the behavior prior to the moves on that day. So this could be a 200 tick move, or it could be a 30 tick move, just depending on overall volatility for that day. So don't say, well, how many ticks should I look for in a spike? Because if it's a slow day, it'll be less ticks, and on a fast day, it'll be more. We need to see one or more areas of high volume close to the low of the most recent push down, an area with a lot of volume over a narrow range of prices. And that is basically the tipping point, because one side in that high volume area is going to get stopped out. You just have to try to identify which side. So you're going to have a push down, then the market will pause, and traders see that the market got overextended, and basically they're going to step back just to wait and see, right? So it's very important that you get this pause. So the market pushes, you get the spike, and you see a pause, which is a very sudden reduction in volatility, right? So if the volatility does not reduce, right? So if the market stays very active, stay out of the way, okay? Even if the market moves back up. So let's say the market pushes down, you get some high volume, and the market whips back up and starts, you know, and it's a very violent whip back up. I would not trade that personally, okay? I want to see the market push down, see the high volume, and for everyone to go, oh, what happened there, right? Now, of course, that's my personal rule. I've got no doubt that rule of wanting to see that pause first, wanting to see the market take a breather, is going to keep you out of some good trades. But to me, the best trades are when that kind of excitement fades, when, you know, everybody in the market can see that it's stopped. Now, we all know the market doesn't just move in one direction, and we don't want to presume that every pullback is a reversal. So this is what I'm saying. We want to see a behavioral change. We don't just see the market whip back up. We want to see it pause. We want to see it slow down. Next, we want to have the traders at that tipping point stopped out. Now, note, with a large volume at any price, you're going to have longs and shorts there, right? And that means there's always going to be stops above and below any area of high volume. So, you know, after a move down, you want to see buyers attempting to run those stops for a move back up. And that's something you could see before you hit that area of high volume, as it trades through that area of high volume, or after it's just moved through your area of high volume. So you don't have to enter at, you know, the best price. You don't have to enter at the low. You can enter once you've got some clear confirmation, some aggression. So for now, I would just say, forget about the concept of being too late to get into this trade. So if you see aggressive buying, you can stick with the trade until either you get well clear of the high volume, you see your pop, or that aggressive trading stops and the market starts to fall back, right? So you can use that aggression. Now, I know scalpers who will trade on one side of the market as long as they've got a lot of trade going into that one side of the market. Now, basically they'll scalp on the buy side as long as they've got a lot of buyers hitting the offers. And they'll think they're actually fairly safe just sitting in that buy scalp as long as they've got people hitting the offers. Then the moment people stop hitting the offers, boom, they pull their position, right? So this idea of having momentum, having one-sided trade, just kind of keeping your market up and keeping you on side, is something you really need to look for, and something that's really useful in managing your trades. So the pop is the first sign that our trade's going to plan. So it's a rapid move your way when the traders on one side of that tipping point get stopped out. Now, you could find that for you, the better trade is to wait for the pop and then enter after the pop, okay? Because the pop, that initial pop that you get, often signals the start of a little pullback. So that pop occurs when traders get stopped out. And that's key because, when you're moving down, sellers are having it all their way on the way down. And then when you get a pop to the upside, it means you've got sellers getting stopped out. So sellers, they're probably not going to be that keen to sell again straight away. And it's also when other traders like us start to say, well, maybe there's some potential in the upside. So it's just helping tip the balance of the market in the other direction. Now, if you scale out of trades, then the pop should be where you get to your first target. So even if there's no continuation after the pop, then you've made some profit. Now, sometimes there's just no pop at all. And when there's no pop, it just means the market's not really clear. Perhaps traders didn't get stopped out, or maybe they're not so shy about selling again. Now, if there's no pop, but just a gradual move up, then for me, there's no trade, right? Or I'm going to get out of the market. Because, if it's just a gradual move up, you've got to be very wary of any aggressive selling, as the market can just move right as swiftly back down and just carry on the move down. So as I said, the pop is often followed by the market taking a breather. It's a good idea to take some profits after the pop. And if the market does continue up after the pop, you're very likely going to be in a trade with an extended move. But be aware that's not always the case. Sometimes in this case, we get the pop, but then, we see the pop here, we've got the trader stuck here, we see the pop, market moves sideways. Now, it's your choice as to how you handle this. You could say, well, I'm in now, I just might as well stay in and see which way the market ends up moving. But in my experience at this point, the continuation down is actually the most likely scenario. So if I compare this to the way I look at the ES, for me in the ES, I will never trade a short. I will never fade the market in the ES unless it's in a tight range. So for me on the ES, my experiences is the continuation is always the most likely thing. So when I see consolidation after a move, I'm always thinking, right, it's going to continue. But again, you might find different markets do different things. So you have to look out for consolidation after the pop. But the good thing is after the pop, you're generally going to have a more orderly market anyway. So this, once you've got this pop and this consolidation, that's actually a bit of time to make a decision, right? So it's not gonna, it's not moving straight against you. And then finally, there is one other scenario to look out for, and that's when the pop is just a little bit too good. Okay, so I'm showing you here, if you just look at this white shadow here, you can see what I'm showing here is a before and after, right? So hopefully that's clear now. I've explained that, right? So what we had here, we had a spike to the downside, which was traded as a long trade. Now the pop up in reaction to that was also somewhat of an overreaction. So we see the high volume on the pop down, and we see the high volume on the pop up. And that leaves you with a decision, right? Do you now reverse and take the trade to the short side, or do you hold on for a continuation upwards? So for me, I think when the market pops up too much, so this was a pop-up of 18 ticks in about 30 seconds. So I kind of presume that the market has possibly gone too far in the other direction. So I'm kind of quite happy to play it in the other direction. Now saying that, the time of day, so you can see anyway that we've got a long on the pop here and we've got a short from this area here. But time of day was actually against on this trade. You can see it's 8:59:22 Eastern time. which is just before the 9 a.m. open on crude. And you might be saying, well, that's strange. There isn't a 9 a.m. open on crude. Well, traditionally, it was 9 a.m. where the crude pit opened. And it's just when a lot more trade comes into crude, right? So at 9 a.m., you know, a lot more volume comes into the market. So just like when a news announcement comes in, the market's going to change characteristics at that point. So, you know, this was a short trade, just wasn't the best time of day to take a trade like this. But again, rules are rules. So, you know, keep an eye on the time of day, keep an eye on the news announcement, because anything that brings a lot more volume into the market is going to kind of negate the amount of volume held at these extremes, right? So this, you might find that overnight, it only takes like 1,000 contracts to get stopped out and push the market the other direction. And then you might find that like at 10 o'clock in the morning Eastern time, it's going to be like 4,000 or 5,000, right? So whenever more volume comes into the market's going to change, and any volume-based approach is going to have to take into account the fact that more volume just came in, right? Okay, summarize. So this trade is certainly not about being right all the time. It's about having a good risk-reward ratio. Now, each market does act a little differently. So you're going to have to focus on one market initially and get to know it well. So for instance, DAX has a lot of spikes, but you've got to be really fast in catching them. Crude and gold are a lot more tame, but obviously there's going to be less opportunities, but they're going to be slightly easier trades. So before you trade this, get to know how the spikes operate in your market. And they do occur multiple times per hour on some markets. So know when they occur, what times of day, and what market conditions you're breaking from, and the failure rates for those particular conditions. Now, don't worry about knowing ahead of time where a spike might appear, because it's really not going to help at all. I would also employ a 3 strikes and you're out policy for these trades. So if you keep fading spikes on a one-way day because conditions are different or you're just not reading it well, there's no point sticking with this trade all day, right? So if you have 3 losers, especially 3 consecutive losers, that should be enough to tell you it's just not really happening today. Now, the samples I showed you were actually from November, but I don't think I'm cherry picking here. So here's one from a couple of hours ago. So this is crude. I just took this screenshot when I was setting up for the webinar. So what we can see here is a volume spike here, right? Where we've got the spike, we've got the volume, but we didn't really see any pop. We didn't really see any sign that the sellers were coming in to sell it. So just a sideways movement. If we'd shorted that, we would have had plenty of time to get out of that trade because there was no pop. And then we can see market moved up to here, hit a little bit of liquidity, moved down, and then pushed up through the previous high. Now, if you know these markets, you'll know it's pretty common to push up through a previous high and then reverse. And that's what we got here. So we got the volume spike. We can see that little blow off at the top as we move through the old high. And that was eventually where the market fell over, right? So you're going to see these every day. Now, I didn't set this up specifically. I just left the crude open. I didn't have a lot of markets open today. Like I said, I just left the crude open today just so I could take a screenshot. And like I said, it was about 2 hours ago when I took that screenshot. So this isn't something that's a rare trade. You've just got to be able to kind of nail the management and just get some good signal for the entry. Now, I'm fairly sure that most of you understood what I've gone over today. Still, there's going to be a catch, right? You're going to need to do something else to make this, or in fact, any other method work. Now, most traders decide at some point to go out and buy or steal or borrow a trading method. And I get emails quite often that say, Pete, don't want to bother with the theory. I don't want to know why. Just tell me where to get in and where to get out of trades. In other words, they want a pattern, a signal to get in that they can repeat without worrying about why it works. But even if you've got the pattern, right, there's something that's going to stop you from making it work, right? Even if you've got the rules, you still will not get it to work. So to a lot of people, trading is all about technique, about what to do. But the reality is, trading is all about understanding a market behavior and then applying a trading technique to profit from it. So if you can separate the behavior from the trading, you will be one step ahead of your peers. So for instance, if you know the market behaves a certain way 80% of the time, but your trades are only 20% profitable, then you've got a problem with the trading side. You haven't got a problem with the market behavior. So the market's behaving as you expect it, you're just not trading it well. So the idea is that at any time when you're reviewing your performance, you should be able to answer a very simple question. And that question is it me or is it the market, right? Am I trading badly because this is new to me and I need to develop my skill? Am I trading well just through sheer luck? Am I trading well, but the market's not behaving as expected in the short term? Or, do I suck or does the market suck? Or does my analysis of the market suck, right? So if you can't answer that question on a bad day, was it me or was it the market, right? You're never going to get through the first few days of any trading technique. Whenever you take on a new trading technique, it will be difficult, right? It's your first time at that skill. So if you can't separate what you expect in the market to do from how you're trading it, you will not get through those first few days, right? You'll suck at the technique, but you won't know it's the fact that you suck. You won't know it's the technique's fine, that the market behavior is fine. You're just not doing it very well, right? And that's why you can go through hundreds and hundreds and hundreds of techniques at approaching the market and never make one work, right? Because you're only focused on the what, not the market behavior. So for a lot of people, this really is the missing link for a lot of people. And the reason that they try and approach the market in so many different ways, they've only got one measure, and that measure is, am I making money or not? So the key to making this setup work for you and allow you to trade in confidence is having this sort of plan. So over the next week or two, your job is to observe volume spikes in one market and to get to know them like an old friend. And you can do that on market replay, you can do it with a video recorder, you can do it looking at historical charts, you can do it live. And what you need to do is you just need to write down your observations and some basic statistics. And don't go overboard with the statistics, right? This is not a science project. But with this, it gives you knowledge and information edge over other people trying to buy trading systems. So with this knowledge, you can then refine the execution plan. So what we've got here basically is the kind of things I'm looking for, right? So this is on the left, just the details of a market behavior, right? And on the right, how I'm going to approach that market behavior, right? And at any point in time, if I'm trading this way and a trade doesn't work, I can say, well, did I do this? And if I say yes, did this happen? Was the market behavior there? And that might be a yes or that might be a no. If the market behavior is there and I lost money, then my trade execution probably sucked, right? So all I'm talking about here is just document the way the market works, document what it is you're going to trade and then figure out how to trade it, okay? So this is where you're going to refine it. This is where you're going to set your expected win rate. This is where you're going to know if you're doing well or not. Now, this is also when you're likely to stumble upon something else. And I've seen a lot of traders do this, following this approach. So they go through the observation period and they see something else, right? And I often get emails. I'll get people email, which is kind of a funny email. They say, Pete, I was looking for A, but I saw B, and it looks like B is much more profitable than A. Is it okay if I trade B? And it's kind of a weird question. It's like, yeah, of course it is, right? But they're so underconfident in actually spotting something themselves. They've kind of drummed it, or they've got such little belief in their own abilities to see a pattern in the market, which is a basic trading skill, see a behavior in the market, that they're scared to actually take advantage of it, right? So in the case of these volume spikes, you might pick a market, you might decide to go and look at wheat or something like that, and you might find that every time there's a volume spike, it is actually much more profitable to trade the failure or the continuation of the spike than the reversal itself. So as you're looking at this market behavior, keep an open mind, because you might just see something that that I'm not talking about, right? And that looks profitable. And as you move then to the execution side, you can measure both sides of this plan, the behavior side and the execution side. So for many traders, all you really know right now is whether your technique works or doesn't work. And with this approach, if you hit a bad patch, you'll know very quickly if the market behavior's changed that week or if your execution sucked. And that really is the key to getting to profit with these kinds of things. Now, before we move on to the questions, I can see there's a lot of questions. I'd like to just consider quickly who should actually be doing this, right? So, for example, if you're already making $1 million a month, should you throw away what you're doing and start trading volume spikes? Well, I would say probably not. So my personal experience at Jigsaw is I get people coming to me at different stages. So some people are already profiting and they're looking for refinement or something that gives them like additional confidence to scale up. We have some people that are like they're consistently always there, like treading water, needing a push. And then you get people that have got nothing that works at all. They've spent years looking for the right system. And you get people obviously at all stages in between. So the trick, if there is one, is to first do an honest assessment and figure out for yourself what's working and what isn't, and try and actually figure out which parts or what knowledge or what skill you got right now that you want to preserve, right? Then you want to pick a style that suits your personality. And what there's probably a better word for this, but I call it your boredom threshold. So I meet traders that trade crude, and to me, I think crude's a great instrument. I meet traders that trade, US Treasuries, which we are really slow. So you've got those two different types of markets. Obviously, the Treasuries are much slower than crude, right? Now, if you've got a low boredom threshold and you try and trade the Treasuries, you're not going to do it, right? You're going to be watching the Treasuries and seeing it not do much for ages, and you'll be on Facebook, right? So you've got to find a style that suits your personality, and also find a style that suits the times of day that you want to trade, right? So for this style of trade, I think this is for some chess playing approach to trading. I don't think this is for you, right? If you find you're more into the like rapid fire kind of trading, in and out, then I think this is for you. Okay, so then you've got to try to have a path for this that lets you layer in to what you do have or what you're doing without throwing anything away. So if, for instance, you've watched crude for 5 years already, that's I don't know if I lost you there. I don't know if my network went down. Okay, so if you've watched crude for 5 years already, that's a lot of experience of watching that market, right? And you want to leverage that. So if you're trading crude or knowledge you've got just watching your market and knowing when it's fast and slow, that you want to leverage as you move forward, right? So what you could do, for instance, if you're already trading crude, you could add spikes to your crude trading. And later on, as you become more proficient and you actually learn how to trade spikes, then the next layer on top of your trading is to take that spike trading skill to another market, right? Now, if you aren't profitable, one other thing I'd say is just look at that profitable state as just a milestone on the way and not a final destination, right? So one of the other things you want to do if you're not profitable is don't try and aim for massive profits straight away. So once you actually get to your first profits, you can do what prop traders do. They can add size, they can add another market with the same technique, they can add in some trade management techniques. There's all kinds of different things you can do once you actually get to profit. But the problem is if you're trying to take too big a leap, then it's probably not really for you. So try and make it a step-by-step process. Try and leverage as much of the knowledge and experience that you've got now, and try and add one benefit at a time until you've kind of got a good understanding of that. And then it's time to move on to the next benefit and improve some more. So your kind of goal is to get to first profits on one setup, one market, and then layer in additional contracts, additional markets, additional techniques to kind of expand on what's working. Now, we will go to questions just in 1 second. If I can actually get to the next slide. If you can, I think Terry will read questions in a second. At Jigsaw, we rarely meet traders at the start of their journey. And some of those traders will have goals and aspirations that align with what we do at Jigsaw, and some of them don't. And what we can't do at Jigsaw is to help everyone. And I'm sure for this webinar, there'll be some people that will be really suited to the volume spikes and some that won't, and that's fine. And we're quite happy to turn people away and say, this isn't for you. This is we're not a good fit. And what we do offer, I'd just like to offer you today is we offer a dollar trade review, which is a 20-minute session where we talk about your trading and what worked and what didn't, and we give you any pointers as to what you can do next, either with Jigsaw or without us. Not because we're trading geniuses, but just because we spend a lot of time working with professional and retail traders, and we've got a good idea what's out there and what actually works. So links there. I'm not going to oversell it. You'll either want it or not. So at that, Terry, can we go to questions?
Yes, 1 second. I'm reviewing them. It says DAX is one of the best to trade this setups. I did a lot of them back in my time. My first question is what Peter uses to filter the situation when there is follow through and no reversal after the initial trade is placed.
Okay, so by follow through and no reversal is follow through the pop or follow through the continuation. Let's just presume that follow through is a continuation. So for me, I actually want to see the market moving up and a real attack, right? So if by follow through you move continuation, that would be the other side coming in. So for me, if the other side comes in aggressively, I'm going to scratch a trade. If I haven't seen the pop yet and the other side comes in aggressively, I'm going to scratch a trade. I'm not really going to worry too much about where the price is at that point. And it's the same for the entry. I'm not worried about the entry price because I just want to see that aggression before the pop. And the same for the downside. I don't really care where it is. If I see, if I'm in a long trade and I haven't seen the pop to the long side and I see a lot of aggression to the sell side, then that's when I'm going to get out. I'm also going to have a hard stop. If the market just starts to float down, I'm definitely going to have a hard stop as well. So I hope that answered the question.
What is the time frame on your chart?
That's a really compressed chart. I think there was probably on some of them it's using like a 30-second time frame. With me, I don't really use time frames in the traditional sense. So for me, I'm a day trader, and I generally speaking, I want to see what's happened that day. So when the market opens, I start on a fairly small time frame, like 10, 15, 10 seconds, something like that. As the market progresses and like we're an hour or two in, I'll change that to a 30-second just so that I can actually see back to the start of the day.
Okay. He says, I have Jigsaw Trading version 5.7 and the charts do not look like that. How do they get their charts to look like yours?
Okay, so what we've got right now, we've got two versions. There's a day trader standalone version, and then there's a plugin for Ninja and multi-charts and Tradeovate. What we're doing is we're actually replacing the plugin with the version you saw today. So the version you saw today is from Day Trader, the standalone. So if you've got the plugin, you've got access to that. What you can see over the next few months, all of the plugin versions will get upgraded to be in line with this. So you can either move to Day Trader now or just wait for the newer version of the plugin.
Okay. I'm trying to find out what I was reading earlier. In your first example, how are you determining that the shorts are getting stopped out as opposed to simply covering their positions?
Okay. It's just, well, we've got a few, right? I think shorts are getting stopped out. Okay, it's this one. Right, so basically what I'm doing is I'm getting in because there's aggression on the buy side. So I don't really know that the shorts are going to get stopped out and it's not just a bit of profit taking. I don't know. But what I'm going to do is I'm going to presume that as long as there's buying and price progression upwards, I'm okay to get into the trade. And if I see that fade away, I can get out. So I don't know, but I'm just saying balance of probabilities kind of tipped a little more onto my side because we're starting to see some size come in. And that's just something that as you watch over time, you get experience in that. And what I will say, it's partly because I know scalpers who will actually, and market makers who will use that, one-sided market to stay on one side in the trade. And the moment that one-sided market stops being one-sided, they'll get out of the way. So it's that more than anything else.
Okay. Is there a specific time when this behavior takes place?
Well, yeah, I mean, you're going to see it more. Well, obviously, you're going to see it more often when early in the day. So when the markets have just opened, there's a lot of people trading. But if you look at DAX, it's all the time, right? It happens. As what somebody said earlier, it happens a lot on DAX. But these trades happen overnight as well, just not as frequently. So they're happening all the time. I think it's just a feature of thinner markets that they just behave like this and they just reverse like this. People just tend to kind of get overextended each side.
Okay, perfect. Do you consider the same process to apply to report spikes, or only to those that occur at basically random times?
I tend to not trade the reports, and most of the reason is the people I know that trade the reports specialize in trading reports, and so I've just stayed away from them because of that. So the answer to the question is I don't know. I can't see why not, to be honest. It's just not my thing. So, and I've kind of shied away from them. Again, this was a supplementary trade for me, so I didn't feel I needed to do it all of the time. And most of the time for me, because really this is my secondary market. So usually what happens is the S&P will open, I'll see the S&P's dead, and then I'll flick over to crude. So the times that I'm actually looking at this, generally after the news releases anyway. Although the exception would be the inventories. So I really don't know, but it would be interesting to find out.
Okay. Do you think this is a programmable strategy, or is it strictly visual or discretionary?
Again, I don't know. I mean, I think if you programmed it, you'd have to live with a higher loss rate. But that doesn't mean that. But I think the risk reward is so skewed that it might be doable. But I'm a kind of an old-fashioned discretionary trader. So that's what I live with. I think the difficult part of programming it would be the kind of tape reading side and really trying to gauge that aggression and the slowdown and when the sellers come in and then they back off. I think that's a tough one to program.
Okay. I don't know if you talked about this or not, but can you talk about iceberg volumes?
Yeah, well, this really isn't about iceberg orders, really, to be honest. What you tend to see with an iceberg order is you'll get to a price and then you'll stay there in churn. Whereas what happens with these is you tend to whip through, and by the time you whip through, you just see that there's a lot of volume at one price. So there was just a lot of resting orders there. So it's not really this. So this scenario is not really a scenario where it's moved down rapidly and then it churns for a long time at these areas. You get the big push down, and you see after the big push down, there's boom, boom, boom. These little footprints of where we traded a lot because there's a lot of resting orders. So for me, I think icebergs for this aren't relevant. If you want to know about icebergs in general, then just give me an email. I'm not sure if my email address is on there. But if you got questions on, no, it's not on there. Great. Can I put my email in, Terry? Is that okay?
Absolutely. You should be able to put it in the chat and do a chat to all.
Okay. Yeah, I haven't got an option to chat to all, so I'll send it to you.
Okay.
Okay.
Got it. And okay, the email is in the chat. Let's see. There was a question I lost. Okay, Peter, to confirm my understanding of your method at a high level, one, look for the spike on a high volume, the setup.
Yeah.
Then two, watch for the order flow for momentum in the other direction, the entry.
Yeah, but just to be clear, you want the spike, and then you need a pause, right? So you want to make sure that after the spike, if the market stays volatile and moves back up, you probably haven't got a setup. But what you want to see the spike down, and then you want to see the market stop and pause, and then you want to see the order flow coming in the other way. You just want to see the sign that people have actually taken a step back. And then after that, you've got the pop, and after the pop, you might be done, but after the pop, you might get a continuation. So it's the spike, the pause, the order flow the other way, then the pop, and you might be done after the pop, but then you get the continuation.
Okay, where would you place your stop if you were taking one of these trades?
I wouldn't. Well, if the high volume is the line in the sand, it's kind of the make or break point. So once I've gone the other side of the high volume, then I really don't want it to fall back against, below, so if it's a long trade and I've gone above the high volume area, I don't want to fall back below the high volume area. So it's not, certainly I wouldn't put it below the low because I'm already into the area where the stops are going to be. So, but it's just basically if I start to see aggression come down and the market trading through the high volume area, that's where I'm going to stop out. But it's very much a discretionary stop.
Okay. If you're looking for a market that is correlated to crude, which one would you choose?
Well, there's not, really, there's not that much. Sometimes the dollar index, you've got, natural gas to an extent. It's not the best market. The crude is not the best market to find correlations, basically. But you've got the dollar index, you've got the natural gas, you've got some of the breakdown products, you've got the other crude contracts, you've got the mini crude. So look at that. But again, it's not the best. There's crude's one of those markets that doesn't consistently have great correlated markets.
Okay. What would be your first rule to filter the spikes? How to tell a pause or a continuation of the initial move?
Well, obviously you want high volume. If you see a big spike down, but the volume's not that high, it just means they pulled the liquidity. So you could see a big spike down before a news event, for instance, because they pulled the liquidity. But basically, there's no real filter. I mean, once you see the spike down in the volume, and then you get the pause, then I'm looking for a trade, because a lot of the time you see the high volume on the way down, but there's no pause. It just stays really, really active, and those trades I'm going to stay out of. So it's really that I'd say the filter is that pause.
Okay. Sorry, sometimes I have a question and I move it and lose it. Where did you go? There's a question on the 3 programs and the prices a bit.
Mm-hmm.
If you can discuss that a little bit.
Yes. I'll probably see if I bring it up. Okay, so we've got there are 3 versions. Give me 1 second. Let's bring it up here. Okay. Right. So the way this works, basically, we've got 3 versions: independent, professional, institutional. The independent, it's all the same software for all 3 versions, but with independent, you get basically a basic 10-hour order flow training course, and also a trade planning course, how to write a trade plan. It covers theory, practical application, and drills. With the Day Trader Professional, we have some kind of advanced educational material, some stuff that looks at particular scalping setups, stuff like that. And then the institutional is where we've actually got the course from a prop firm. So the way we do it is the way it works is if you're doing okay as a trader, or you're looking to improve, you've already got some techniques you want to improve against, then the independent or the professional is really what you need, because you're already kind of part way there. You're just looking for the icing on the cake. You could start with the independent and then upgrade to the professional later. That would be fine. The institutional is kind of full-on scalping course that takes you from like 0 to covering about 20 trade setups. If you were in a position where you had absolutely nothing, where you don't know anything about trading, nothing you've done's worked, and you just feel like you're completely stuck, that's the one really. It's almost as if the institutional is the beginner program, but that's the one that actually says, right, here's all of the scalping setups, here's all the stuff you need, here's how to find your own, here's how to keep up as the market changes. That's the institutional. So if you already got technique, your long-term analysis, you're just looking to refine, it's the independent or the professional. If you just if your hands in the air, just like tearing your hair out and about to give up, then that's what the institutional's for. And you can obviously upgrade between them if you buy one and then want to move later. I hope that makes sense.
Perfect. Thank you. Um, let's see. Getting back to the setup. If you jump in on a trade based on the volume spike setup and a trade works against you, what kind of metrics do you use to decide when or where to stop out? I think you
But to
covered a
be
little bit
honest,
in the other one, but
yeah, to be honest, I don't, like on it's a weird trade, right? Because the potential in the trade is like really big. It's a real skewed risk reward trade. So again, I don't worry about the entry price, and conversely, I also don't worry about the exit price too much. I don't worry about the stop out price. So for me, the stop out, we've talked about the different phases of the trade. First of all, before the pop, I'm going to get out the moment I see any aggressive trade, and certainly the moment we start trading below the high volume area that kind of I was expecting to stop out, then I'm out of the trade. So it's not really a specific number of ticks. Sometimes I'll have got in the trade a little bit later, so that'll be a higher tick stop, right? After the pop, I'm going to stop out if we move sideways, and that's going to be I'm going to be stopping out in profit. So before the pop, it's just below the high volume. So you might decide if you've already moved 10 ticks above the high volume area, you're not going to get in the trade because it makes you stop too big. But generally speaking, you're probably talking 5 or 6 ticks. Now, if you want to know, like on average, there's no strict metric, but on average, you're looking at 5 or 6 ticks max, generally speaking. Oh, and that would be for crude. Sorry, I have to qualify that. That wouldn't be for DAX. That would be for crude.
okay. There's a question here. It says, Peter, can you please expand on as price moves down or up, all relative, more people are willing to go short, but less people are willing to sell?
Okay, let's go back to that. All right, so there's a finite number of people in the market, right? So if you think about it, as we move down, these are the sellers. These are the sellers' positions, right? So as you move down, you gather more and more and more short positions. But if you think about it, if there's only 10 of you in the market and you're all short as many contracts as you can go, of the 10 of you, none of you are willing to sell anymore. You've already reached your maximum position size. So it's not something you can actually quantify. It's just something you have to be aware of, that obviously at some point, there's just nobody left to sell because everyone's got their maximum position size. And then the other reasons nobody's left to sell is because it's already moved down so much. And people feel a bit kind of freaked out by selling after they've moved down too much. So your number of net short positions is growing, and these are the people, the net short positions, these are people who need to buy to take a profit. So that's why. So these net short positions are really what start to kind of spike and cause the continuation to the upside when they unwind. The people willing to sell more, running out of people willing to sell more, is really why you get the pause, right? It's like, because you got all these sellers and sellers and sellers, and then boom, there's nobody left to sell. And sometimes you get a pause and it just carries on straight down, but sometimes you get a pause and there really is, you really did run out. So it's a theoretical concept, but I think it's fair. I think you can't. There's a lot of this stuff you can't prove. You can't say this is absolutely undoubtedly the case, right? But I'm fairly confident that this is actually what's going on. That you just run out of people that are willing to sell.
Okay. On the behavior and execution slide, can you explain the takes trades only into a level and not after the level quote?
Okay. Right. All right. Where is it? Right. So this one. Take trades in and level, not after the level. That's fill that. So this is just a sample, right? So this is just me saying what should be in the plan, and I didn't even finish that sentence there. So that's just one way to trade the behavior on gold, right? So you have to look at the market behavior first, and then you have to say, right, based on the market behavior and the failure rate, maybe I'm only going to take trades below my high volume level. So the level would be the area of high volume, and the trade would be I only take trades if I'm below that level, actually approaching that level, not the other side of the level. So this badly written slide because I haven't finished the sentence. So this slide is really just to give you the concept of behavior and execution. It's not to give you hard and fast trading rules.
Okay. We're running out of time, so I'm going to make this the last question, and it's a question on the Jigsaw plugin and a new day trader. It says, if you purchased Jigsaw plugin back in 2015, is day trader an additional cost?
No, it's free. It should be there. It should be there already available for download. And if it isn't, then obviously let me know.
Okay. And then last but not least, what platforms does the software work with?
Well, it's a standalone platform, so you can use it with CQG, Rhythmic, Gain Capital, IQ Feed data. And then we've also got a plugin that works on Tradeovate, multicharts.net, NinjaTrader 7 and 8, and also on the Gain Capital platform, OEC Trader or S5 Trader at the moment. So those are the platforms we support.
Okay. One slid in, and I want to ask it. He's using NT8 in simulated mode, and is there a particular reason why he cannot see the icons at the top of his auction vista chart for adding cumulative delta and volume? Is it due to being in sim mode?
It's due to the fact that that's the older version and it's going to be upgraded. There's actually a beta program now. We've got something called a bridge between the day trader platform Ninja and NT8. So if you go to download day trader, you can actually hook day trader up to NT8 right now, and you've got all the day trader features, but it'll be sucking the data from the NT8 platform. So that's the future of the plugins, basically building a bridge between the new product and those trading platforms.
Okay, perfect. Thank you for the webinar today, the information, and for spending some time with us this evening.
Thanks, Terry. Thanks for having me.
Absolutely. Take it easy.
All right, thanks. Bye.